Hey there, I'm the pit bull of accounting, and I want to take a moment to talk to the do-it-yourself bookkeepers in the room. Yes, I'm talking about you. For some reason or another, you have decided to handle your own business bookkeeping. Perhaps you actually like doing it. I highly doubt it, but humor me. Or you think you can afford the help. I would like to debunk this myth at the end of this session. So, if this describes you, then this webinar is for you. We are going to talk about the top 10 do-it-yourself accounting mistakes you didn't know you were making and how to fix them. Now, before we get started, I want to introduce myself. My name is Christina, aka the Pit Bull of Accounting, and I own and operate Moss Financials. So what's my story? After 20 years working in corporate, getting dragged down, thrown under the bus, undervalued, and unappreciated, I decided that enough was enough. From my early years working as a young staff accountant for a one-man show, I knew that number one, I loved small businesses. Number two, they needed help, my help. And number three, I could really make a difference in the lives of business owners while providing the flexibility and support for my own family. Win-win. So, here I am, protecting profit margins to the fearless revolutionaries who have decided to face the brave new world of entrepreneurship. Nice to meet you. Now let's go. Okay, number one, DIY mistakes. Recording meals and entertainment in the same account and recording them wrong. First off, let's just talk about the fact that the IRS changed its policy on what can and cannot be deductible as it pertains to meals and entertainment. Prior to 2018, meals and entertainment for businesses were both deductible. So, what is this exactly? We know what meals are. You go out, you sit down, you eat, it's a meal. Entertainment is pretty much everything else that you do, for example, golfing, night at the ballpark. Now, let's get this very clear. These are activities that you're doing with a client, talking about business, or an employee talking about business. So, to keep your tax accountant happy and to show that you care, separate those expenses. And just because you have the business debit card in your back pocket and you are the sole owner and you're craving noodles and company like I do for lunch, doesn't mean that you can whip out that business debit card and start swiping. While you're eating your noodles and company, are you making business calls, sending an invoice, or writing up a company memo, or are you watching Stranger Things on Netflix? Think about your intent before you start expensing lunches. Number two, recording a uniform expense for an outfit you purchased for a photo shoot. No use saving that receipt for that $200 outfit you purchased and the cost of hair, makeup, shoes, accessories, etc. from that photo shoot. It won't fly here. Contrary to popular belief, there are some folks who think that these things are business expenses because it falls in line with the photo shoot, which may be expensed as marketing or advertising. Now, unless you are an astronaut and you purchase a suit that you can only wear in space, buying an outfit for a photo shoot that can be worn to your grandma's 80th birthday party is not a uniform for business-related expenses. So, enjoy your $200 outfit because you just bought it. So, how do we remedy this? Simply, realize that most outfits and related accessories are not business expenses because they can be worn outside of business activities. And since we're talking about debit cards, let's go ahead into three, using your debit card as a personal ATM. If you are a sole proprietor, then just kind of sit quietly for a second. This doesn't apply to you right now, but it may in the future. For all of my LLCs and S Corps, listen up. Stop using your business debit card as your personal piggy bank. Yep, I said it. You have no idea how many times I review bank statements to see frivolous debit card purchases from personal transactions. lunch for the kids on this statement, a movie ticket on that statement, a child support payment. Yep, I have seen it all. What you are doing is risking piercing the corporate veil. So I know you're probably saying, Christina, what are you talking about? What corporate veil and who's trying to pierce it? I'm glad you asked. So, was your intention to file as an LLC or S Corp? What was your intention? It was for that limited liability protection, right? Well, how much protection you think you will have if something really happens and your business is at risk of lawsuit and the powers that be discover that you haven't done a good job of separating personal from business? It's not so protected now because you've blurred the lines of business and personal. Stop doing that. Schedule regular owners draws for my LLCs, and for my S Corp folks, you, my buddy, are on payroll. Those are your only two options. Now, since we're talking about payroll, let's get into the next one. Number 4, putting yourself on payroll. This one is a doozy. You have no idea how many phone calls I get from folks wanting to, quote, put themselves on payroll, end quote. And they have an LLC that's taxed as a disregarded entity, which basically means your revenues and expenses flow through to your 1040. Now, for some, what they really mean is, help me to determine how much money I should take as an owner's draw each month. Understandable. But there are those who are actually asking to be an employee of their LLC. Nope, not possible. You are not an employee of your LLC. You are a member. If you have a partnership, then you have more than one member. You will have to pay self-employment tax on your 1040. You cannot get a W-2. Are we clear about that? Good. Now, for those who have S Corps, you are required to be on payroll, and the IRS clarifies this payroll as reasonable compensation. So, how do we fix this? Well, first, determine how much your business can support regular scheduled owner's draws and take them. Those are for my LLCs. And for my S Corps, determining your reasonable compensation takes a few extra calculations. It's best if you sit with someone and have them review your financials and determine the best path. If you're interested, we have that service, and the link will be provided later to have a one-on-one chat to get all that cleared up. Number 5, classifying your team as 1099 contractors. This one here can get you into a lot of trouble if you aren't careful. There is a very strong line in the sand that separates 1099 contractors from employees. So, what happens if the powers that be realize that you've been paying a 1099 contractor when really they should have been an employee? Well, there are fines, of course, and then there is a tax liability of having to pay back the employment taxes that you would have paid if they had been an employee from the beginning. So, how do you know if you have an employee or a 1099 contractor? Let's follow the path. There are 3 rules that the IRS has provided to help us to determine if we have an employee or if we have a 1099 contractor. The first rule is behavioral. Do you have control or have the right to control what the worker does and how that worker does his or her job? So kind of look at the flow here. If you have a 1099 contractor and they want to do things in Microsoft Word instead of Google Docs, and you say, you know what, that's fine. I don't really care what system you use as long as you get the work done. 9 times out of 10, in this situation, they're probably a 1099 contractor. You're fine. But if you come back and you say, hey, I want you to use Google Docs, end of story. you have too much control over that worker, and that worker could possibly be classified as an employee and not a 1099 contractor. Rule number 2, relationship. Are they performing a key business function? And this one gets so many people in trouble. If you have a worker and they're performing a key business function of your business every day, every week, more than likely they are an employee. Now, if they do some one-off task for you, a project, say for instance you have a lot of collection that need to be collected, you have a lot of receivables out there and people haven't paid you, and this is kind of a one-time thing. You hire someone, hey, make some phone calls for me, see how much money you collect, and then after that project, maybe they go on to another project and maybe they're done. 9 times out of 10 they're probably a 1099 contractor. Don't let this one screw you up. I've seen a lot of people fall into this trap. Rule number 2, part 2, relationship. Are you offering employee-like benefits? So, if you have a worker and you decide, you know what, you're going on vacation next week, I'm going to pay you for the whole week. More than likely, you're treating them as an employee. Don't do that. And finally, rule number 3, financial. Are the aspects of the job controlled by the company owner? You have an employee or a worker, my apologies, you have a worker, and they say, you know what, I kind of want to be paid on the 15th of each month. If you, as the company owner, say, hey, no problem, invoice me, I'll make sure you get paid on the 15th, then we're good here. But if you hunker down and you say, no, I want to pay you on the 15th and the 30th of each month. I'm going to pay you bi-weekly, every other Friday. Then more than likely, you're treating them as an employee. So, how do you fix this issue? If you determine that your 1099 contractor is really an employee, we need to set them up on payroll immediately. There are a number of online payroll providers that you can use, and they're easy enough to figure out. If you decide to outsource it, well, check the end of the seminar for a special. I got you covered. Next, recording loan proceeds as income. Now, I see this quite a bit, and it makes my head dizzy every time. When you receive loan proceeds from whomever, it is not income. Yes, you're right, it is cash. We get that, but not income. It's actually a liability that you have to pay back over time. So, don't make the mistake of recording cash from loan proceeds as income. Instead, record it as a liability and remember to reduce the liability each time a repayment is made. Number 7, recording Square, PayPal, Stripe deposits as gross income. Now look, I won't fault you for this one. This is a little known fact. Do you know that all of those merchant processing fees that you pay to take credit and debit card payments, well, they really should be recorded on your books as a cost of sales, a cost of service, depending on what's being provided. So, this is what Square, PayPal, Stripe, this is what they're doing. They capture the payment from your client, take their fee off top, and then deposit the difference into your account. In actuality, though, the total amount captured from the client's credit card is really your true gross revenue, not the net deposit. Now, you're probably thinking, won't it all equal out in the end? In a way, yes, but it's always best practice to know and understand all of the costs associated with generating revenue and the cost of doing business. So, if you don't record those merchant fees, then how will you know your true cost? Hint, you won't. So, how do you fix this issue? Using the merchant account reports that you are reviewing each month, hint, hint again, determine how much you paid in fees. You can either record one big entry at the end of the month to debit merchant fees and credit sales, or tackle each deposit individually. It's really up to you. Number 8, connecting your bank accounts to QuickBooks without reconciling the account. I am not going to sit here and lie to you. I have had to charge very handsome sums of cash to clean up and fix QuickBooks Online accounts, Xero accounts, you name it. The culprit? Folks connecting their bank accounts to QuickBooks or Xero without recording the items. So let's talk about this. It's great that you have figured out how to connect your bank account to QuickBooks, but that's only half the battle. Now you have to record those items in the QuickBooks account and reconcile the bank in order for those items to quote unquote disappear, meaning out of your bank feed screen and into their appropriate accounts. Now here's a word of caution. You don't realize how many transactions are flowing through your account until you haven't touched them in 5 months. Don't be that guy or that gal. If you're going to take the time to figure out how to connect it, then take the extra time to record and reconcile. Who knows better than you who those transactions are for anyhow? And here we are at number 9, using your personal credit card, debit card for business purchases and recording them as business expenses. Sounds funny, I know. But you don't know how many times I see clients trying to pass off expenses paid on their personal credit card as business expenses. And the thing is, they could be real business expenses. But here's the deal. Remember that corporate veil we were talking about earlier? Here it is again. Now, for my sole proprietors, this doesn't necessarily apply to you. But for my LLCs and S Corps, absolutely. If it is an expense on a personal card for a real business expense, then it has to be recorded as such. An expense to the company and a liability paid back to you. Otherwise, it's simply an owner's contribution. Okay, let's take a pause. How are you feeling so far? If you have been helped with any of the material in this webinar so far, give me a whoop whoop in the comments below. If you think that you have been exposed by doing some of the things you shouldn't be doing, that's okay. You know now and you can fix it. Now, if you decide that you may need someone to walk with you to get these things done and corrected, don't fret. We all know that you won't be DIYing it for too much longer. This is just a temporary means to an end until you are ready for full service monthly support. But in the meantime, I do have a special for you. Since you are watching this webinar right now, I want to give you first dibs on consulting services with yours truly. 90 minutes of get your hands dirty deep diving on a specific topic or issue of your choice. Normally, this 90-minute Fix My Book session is $275. But for the next 7 days, I am offering this service at $210. The call to action button will display momentarily. Okay, enough of the sales pitch. Let's tackle number 10. And number 10 of the top 10 DIY accounting mistakes you didn't know you were making and how to fix them. Syncing all of your apps to QuickBooks or Xero. Look, I get it. You have Dipsado, you have Receipt Bank, you have Stripe. I get it. But now what? Your accounting system is your Bible. It holds all the truths. And if it becomes corrupt because some third-party system has downloaded information incorrectly, it'll become your worst headache. Trust me. There is actually a science behind syncing third-party apps to platforms like QuickBooks and Xero. The third-party system has to know what accounts to use in QuickBooks in order to sync. Some of the things that I have seen with bad syncs are duplicated entries from customers, vendors, sales, items being recorded to the wrong accounts, say for instance, a sale being recorded as a liability, and transactions recorded as sales receipts and sitting in an account called undeposited funds, living out the best of its useful life. Note, items should never stay in undeposited funds. So, what's the fix? Well, if you haven't synced anything up to your accounting system yet, don't. My best advice for you is to have someone review your accounting system. Make sure it's set up properly for your business first, and then walk you through what apps will work best for your accounting system. There's a thing called mapping, and if you map a system to the wrong account in your accounting system, it's worse than Freddy meeting Jason. for all of my 80s babies out there. Now, if you have taken the plunge and have synced third-party apps to your accounting system, then I suggest you take a hard look at how things are being recorded. If things are being recorded incorrectly, disconnect the sync and start the cleanup work. If it's right, get a second opinion, preferably from a QuickBooks or Xero Pro, and not your sister's cousin's mama who took a QuickBooks class. Now it's time to pat yourself on the back. I see that you are serious about setting the foundation for your business, otherwise you wouldn't be here. So, kudos to you. Now, even though our time here today is over, our connection is far from over. Please know that it is my honor to help you through all things accounting and bookkeeping, and I am never more than a phone call away. Again, I would really take advantage of the special Fix My Book session pricing before it's too late. An investment in your business now will save you the heartache in the future. If you are tired of the do-it-yourself approach, then your next step is a discovery call with me. This call is for those who are ready to hand off their accounting task each month. And for those who think that having an accountant on your team is an expense that they cannot afford to pay right now, let's look at the alternatives. You can keep doing it yourself, but that takes time away from revenue-generating tasks that you could be doing. And what seems to be a simple accounting mistake may cost thousands of dollars to fix, and may end up costing you more business. If we are truly ready to grow our business, we understand that investments are key, and having a strong accounting office is the foundation to any business success. So long for now, and I'll talk to you soon.